Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Your Money, the personal finance edition of Merryn Talks Money. In these bonus podcasts, we talk about the best strategies for making the most of your money. I'm Merryn Somerset Webb. So this week, we're talking about venture capital trusts, or VCTs. A few of you have written in asking us about VCTs. What are they? What do they do? How do I get them? So we thought it'd be a good time to bring in an external voice to talk to us about exactly what VCTs are and if they can offer some of you a more tax-efficient investment option than maybe pensions, particularly in light of the changes we saw in the autumn budget, which of course increased some of the tax penalties on pensions. So with me today is Tony Dalwood, CEO at Gresham House. Gresham House is a specialist alternative asset manager managing a variety of VCTs, 2 Barrows-Mead VCTs and 2 Mobius VCTs. Welcome, Tony. Thank you so much for joining us today on what is a relatively complicated subject.
Real pleasure to be here, Merryn.
Okay, I'm going to start with one of those big questions that people find off-putting, but you're so expert that I know you're not going to find it off-putting. Tony, what is a VCT?
So VCT stands for Venture Capital Trust. Venture capital trusts are listed vehicles which are tax-efficient ways of investing in early-stage growth companies, primarily private companies, small private companies, but there are some AIM VCTs as well that invest in AIM for those companies that are eligible to be VCTable, so to speak.
Okay,
VCT
I'm interrupting you already because we are super basic here. What is AIM?
AIM is the alternative investment market of the London Stock Exchange, typically early-stage companies that are starting on their journey for growth.
Okay, so an AIM company is a listed company, but not a fully listed company.
Correct. It has certainly slightly different rules, but typically it's an easier way of getting listed and access for the public to buy and sell shares in that AIM listed company. As I say, primarily most VCTs are made up of private companies, unlisted companies, small ones with growth ambitions.
Okay, so what then is the difference between a VCT and a private equity trust?
So there are many private equity trusts, listed ones. 3i is an example of that. And these are trusts that typically hold private companies in a listed structure. On 3i's case, it's a London Stock Exchange, the main list. And you can access buying those shares on the London Stock Exchange, and you're getting exposure to the underlying companies like 3i. The biggest exposure you'll have on 3i is a Dutch supermarket business called Action. So you have many different private equity trusts that give you underlying private equity exposure through a listed vehicle.
Okay, but it's the same idea. You've got private companies, unlisted companies wrapped up inside a trust.
Correct. And the difference between a VCT and a standard private equity trust like 3i or HG Capital Trust would be that the VCTs are tax efficient. The VCTs offer 30% income tax relief when you buy new shares, and they provide, in some respects, more flexibility than some of the pension tax changes that are happening at the moment. So you have some tax relief by investing in the new shares to then support the UK's ecosystem of growth small companies.
Okay, so tax relief is offered by the government in order to encourage us to put our money into smaller companies to help them grow, right? So let's talk about how that tax relief works. So I buy new shares in a new launch VCT. I put the money in and I can then apply to get the tax I've already paid back, the income tax I've already paid back.
So you'd put £100 in to the new shares, you'd get the shares worth £100. And then for your HMRC submission, you would then be able to indicate that you've bought £100 worth, and you'd be able to claim back £30 offset against whatever income tax liability you had in totality for your own personal affairs.
As long as I'd paid that much income tax over the year, obviously.
Correct.
Okay.
Correct.
And there is also a capital gains tax relief here as well, right?
Correct. So if and when you make money on the shares in due course, you must hold them for 5 years. It's an important point. So once you've invested, you must hold them for 5 years. Once you've held them and you make a capital gain, there is that a zero capital gains tax on that, as well as these investment VCTs do pay dividends, and they you also have income tax-free dividends.
Okay, so I don't pay capital gains on any gains, and I don't pay any income tax on the dividends that I get.
Correct.
Quite big benefits. And am I able to roll previous capital gains into a VCT?
Yes, you can do that.
And I can defer the capital gains tax on the money that I roll in?
Correct.
Okay. So it's pretty good, right?
It's very good. I mean, you must remember all investments sit somewhere on the risk return curve. And
We'll come back to that bit. We'll come back to that bit.
Okay.
I just want to establish exactly where we are tax-wise. So
Yeah.
let's say that I have bought shares in one of your VCTs on launch. After 5 years, I want to sell them. Who do I sell them to? Who is going to buy this stuff without the tax relief?
There is a liquid market to some degree, but as you say, sometimes that isn't there. The company themselves have a buyback mechanisms, so they often step into the market and buy from their balance sheet, from realized gains, from exited investments on their balance sheet.
Okay, or perhaps do VCTs have a set life in that we'll wind it up after 5 years or 10 years and you will get your money back?
Some may do. Typically, they are evergreen, which means they carry on until the boards decide in consultation with shareholders that something should change.
Okay, so there could be situations where you buy into your VCT at the beginning, you get your income tax relief, and maybe you get your capital gains tax relief, you've had your tax-free dividends, etc. All marvelous. But when you come to wanting to sell, you may end up doing that at a discount to the net asset value, which might, to a degree, offset your tax benefits.
That is possible. Typically the buybacks, if you look, happen much closer to NAV than the average discount on investment trusts. 5% may be a number that I have in my head, but you're right there that you don't always get your money back at NAV. So the important bit is, one, that the NAV has grown over that 5-10 year period that you hold the shares, and then two, what is the commitment by the board and the company to buy back shares or provide a secondary market in those shares to be bought by other people.
Okay. And the other thing that we should talk about is the fee structure, because it tends to be that VCTs are very significantly more expensive than other types of listed investment vehicle. So a big listed investment trust that, say, invested in liquid UK equities or dividend-paying equities or something like that would tend to have a total expense ratio of below 1%, but you would expect a VCT to have a total expense ratio of much, much higher than that.
You're correct. There's the intensity and resourcing required to invest in private equity companies and small ones is much greater than buying and selling shares on the London Stock Exchange. As a result of that, the fees tend to be higher. Private equity fees as a whole tend to be higher. If you look at the unlisted market as well, you'll see them, and they can range typically between 1.5% and 2.5%, and they will have some performance fees typically as well.
Yeah, so you'll get that management fee, maybe 2%, possibly a performance fee on top of that, and then there are other charges around the edge. I remember reading a while back that a lot of VCTs will also charge the companies in which they invest a couple of percent a year for the input that they give to them, for example, and that's going to come back in the end as a charge on the end investor, effectively.
Well, it's a charge to the company typically that the underlying company pays for could be board representation or value creation plans or advisory work or strategic work, and that's charged typically to the company themselves.
Yeah, but it's an expense. If it's an expense to the company, it's an expense to the investor in the company, right? So it all ends up in the same place. So there is a degree of tolerance among investors to higher fees, to higher costs, to discounts, etc., because you're getting such a great tax rebate along the way that it's not, the fees are not quite the issue with the VCT as they are with other types of vehicle.
I think fees are always an issue for an investor, so they're always under scrutiny. They'll certainly not be dismissed by boards. Boards do their fiduciary job and make sure that the manager is held to account for its fees. But the market price of the fees are pretty well transparent. Private equity fees are pretty transparent, and they're all in that region.
All right, so performance, how's it been?
Well, it varies. I mean, it depends on the manager, and it depends on the type of sectors you're exposed to. The last few years, may have been affected by COVID. Small companies with stretched balance sheets that went through COVID in a tough time. So I'd say the last few years, some VCTs have done quite well. Our Mobius VCT done exceptionally well, and some of the others have probably had a tough time, but they're still doing what they say in the tin. And I think it's really important to remember these are not short-term investments. You must have a long-term horizon when investing in them.
What do you mean by long term? Is that 5 years?
Well, at least 5 years for a VCT. You can't get the tax benefits without that. But I would say much longer. Venture capital trusts, typically, not trusts, but venture capital itself, you go for a very diversified portfolio because of the high risks associated with the underlying companies. And you should look at typically a 10 to 15 year horizon.
Okay. I'm still wondering about how long a VCT lasts, and that, let's say after 15 years is the long term. Pretty much everyone who might have invested when that VCT was launched might want to be out by the end of 15 years. So who are the investors after that? Who holds a VCT after 15 years?
Well, some people still retain them after 15 years because they could be investing, in their 30s and 40s. And they can hold them well into pension, so they can hold them for 20 to 30 years. I mean, Baronsmead's been going since 1995, so you've got something that's approaching 30 years, and I think some people are still holding them from day one. And so I think there is a range of investor. I think it's important. This is an important point that people need to recognise, that this is a benefit to both themselves from financial returns, but also society in the UK for ecosystems of early growth companies that contribute to economic growth. And it's a very, very important part of UK society.
Because there is that funding gap for smaller companies in the UK.
Yeah, because over history, UK has been at the forefront of finance provision, healthcare, innovation, and VCTs are there to catalyse some of that as well. And I think with the work, we're competing in a global marketplace. The US is now the default for technology and early stage related growth companies, and we've lost some of that market share and positioning. Yet we have some phenomenal academic institutions and platforms and hubs across the UK that have some very great specialisms, and we really should be, catalysing and supporting them.
Okay, tell me about the types of companies that are in. You said the Mobius VCT had done very well recently. What kind of companies are in there?
Fundamentally early stage companies, but they're things that So here's what I'm thinking of. An API platform developed by a team called Ozone API. It's developed by a team that designs open banking in the UK. It's a global platform, so it's selling to global customers. And these are for banking users. When you look at you're using your app in order for security of that, and then to access your accounts and the various different services you want from your own bank. These are the types of things that are developed within that product and that company. There's another one which is an Irish and UK-based company called CitySwift, which is a data platform that increases the performance of public transport networks, uses AI analytics and simulates and optimizes. So again, lots of these are technology related. They're at cutting edge of innovation, and they are the future of how the world is evolving, rather than historically VCTs. Previously, you could invest in a much more traditional old style businesses, and you might be able to invest in asset-backed businesses that have property like pubs. Those things are no longer able to be invested in within VCTs.
Okay, so let's talk about most investors and their wrappers and their journeys. So I think a lot of listeners to this podcast, they will have a pension. So they'll have things inside their pension wrapper. They'll have things inside their ISA wrapper. Is this the next stage? So once you've pretty much maxed out your pension, it's a lot easier to do than it used to be, maxed out your ISA, although of course we're talking quite a lot of money there. That's up to 60 grand a year per head, right? If you're using your maximum pension, maximum ISA. Is a VCT the thing that you would come to next when you're looking for tax efficiency and you've filled your other wrappers?
It's definitely one that you would consider immediately. Of course, there are other private vehicles where you can get LAHT or a capital allowance, capital gains allowances, benefits. So there are other things, but they are, they're more for more sophisticated investors. Let's say probably not the retail investor who's got who's just about maxed out on their ISAs and their pensions. So I would definitely put them there as that next choice. But if you are further up the quantum scale or the sophistication or risk return scale, you can go into some direct private deals.
Direct private deals. How would an ordinary investor do that?
Well, there's EIS. That's one way of doing it. You can get a similar type of tax rates on a single deal, single project,
The
single
EIS
company.
being Enterprise Investment Scheme.
Correct. Yes, and that's another way of identifying a company that you think is good for whatever reason, for both management, valuation, sector, and you can put money directly into that single company. Of course, it is much more high risk return, but that is another option as well.
And what are the tax benefits there? How does that work?
So it's very similar. You get 30% back from investing, and you have your capital gains benefits. You have to hold it for a certain period of time. There is also something called SCIS where you can get up to 50% back. I think that's the number, 50% now still. And so that's for a smaller company at an earlier stage. So there are these other much higher risk opportunities where you can go as well to put into your portfolio.
But by the time you get to that, you are really into the world of very high risks, aren't you, with one individual small company?
Yeah, I mean, so if when you look at portfolio construction, a single company does have a specific risk. However, if you have an edge, then you believe you're getting a good valuation, you believe in something that can be executed on, then you might have an edge that says, it's not as high a risk as some people perceive.
All right. We talked briefly, Tony, back at the beginning of this about the funding gap in the UK. Are we really behind the curve technologically, do you think? I mean, when you look at Keir Starmer, was it yesterday, the day before, talking about, I'm going to change back, it's last week, it's going to be. When you look at Keir Starmer last week talking about AI as the driver of growth in the UK, etc., is this possible, or are we genuinely too far behind the curve on some of these things?
This country has a culture historically of being innovative and entrepreneurial. And if you put an ecosystem around that, then you will get good results. Therefore, people should be commended to make money and be a success, and they should be commended also if they take risk and they fail and they get back on their feet and go again. And this is what entrepreneurialism and startup and growth companies are all about. We are behind the curve when it comes to some of that now. We used to be at the forefront, but now we are behind. If you look at the US, the money, the capital gravitates to the US. When people think about listing, they think about the US primarily, and the London Stock Exchange is in the secondary field. That is not a good place to be. It's not where we were when I started in the 90s in investing. So how do we change that? It's a cultural change. VCTs are part of that, but venture capital and is part of that. But in general investing and commending good managements to take risks and then to be rewarded financially and otherwise should be commended and applauded, not taxed. And that is an important point. The AIM market, I've mentioned earlier, the growth market, has gone from about 1,800 companies 15 years ago to about 700 today. And people talk about that, but they don't then start addressing how do we solve that. And there's many components to the solution, and one of them is the fact that it's the regulatory burdens, the transparency, the constraints on making money and being successful. All of those go to the best management team saying, why do I need to be listed? If I have an option, I'll do the option.
I'm going to put you in charge, Tony, completely in charge. You can do whatever you like. What's the one policy change you would focus on to try and fix part of this?
It would be the regulatory burden around transparency on being listed, and therefore capital access, getting the best management teams to run quoted and unquoted companies. Those things are, if you've got the best management teams, the rest will flow.
Is there anything we could do with the tax system to encourage companies to list or encourage companies to be more innovative? I mean, I always think it might be useful if, say, when a company listed, it had a lower rate of corporation tax for 5 years or something like that.
Well, you can see the benefits of having, from a societal point of view, in Ireland, lower corporation tax, 12% until recently, and look what's happened to Ireland in the last 10 years. It's phenomenal. Yeah. The amount of the money that's gravitated there, but importantly, the skills, the companies, the global companies that are now based there, they are sitting pretty now, thinking about what to do with the surplus for society in Ireland as a result. So you can see that trickle down effect it works.
Yeah, let's hope Rachel Reeves is listening. Now you've got a new launch. I know you've got a new launch coming out with Baronsmead, right? You've got a share offer.
Yeah, so one of our brands, Baronsme, is coming out a new VCT offering in the next week or so. And they cap the amount that they raise typically between up to 50 million. So hopefully, like last time, we hit the cap. But Gresham House has many of these offerings for people, and we've always got something on the go, Merryn.
I know you have. And that's somewhere, listeners, for you to go and look if you have filled up every single other wrapper and you're looking for something with some tax benefits and possibly rather more risk. Tony, is there anything that we haven't covered that we should cover?
No, I think investing is a fundamental part of economic growth. Taking risk, making returns, and applauding people for taking that risk is something which this country has been good in history, and we really need to continue to do that.
Well, hopefully we will get better at that over the next decade or so, possibly not the next couple of years. Tony, thank you so much for being with us today.
It's a real pleasure. Good to speak again.
Thanks for listening to this week's Merryn Talks Your Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter. I'm at MerrynSW, and John is John_Stepek. This episode was produced by Summer Sadi and Moses Andam. Sound design by Blake Maple. The executive producer has been Brendan Francis Newnham. Questions and comments on this show and all our shows always welcome. Our show email is merrynmoney@bloomberg.net.